Welcome everybody from around the world. We're very happy to have Gauti Eggertsson here from Brown to talk about whether negative nominal interest rates are expansionary. And please interrupt Gauti anytime. We want to have a lively discussion. Gauti, the floor is yours.
Thank you so much. So I have actually with here one of my co-authors, Ella Wall, that will answer any questions. And this is also joined with Rainer Julesmith and Larry Summers. So let's see here if I can get this to work. Okay, oops. That wasn't working too well. So what's the motivation? Well, the motivation is straightforward, right? I have spent, like many of you, the last few years working on papers modeling the zero bound. And then, of course, many central banks started charging negative interest rate, which raised the question of all sorts of questions, whether this bound was relevant after all, or for some reason here, whether this bound was relevant at all. And then also, what happens when you went into this uncharted territory of negative rates? Perhaps it doesn't really need much of a motivation in this crowd why we want to be interested in this question, because now we have seen a handful of banks implement a policy of this kind in Denmark, Euro area, Japan, Sweden, Switzerland. And in some respect, it is a pretty radical new experiment, and one that I think we don't have any consensus on yet how it works. So this is sort of our preliminary attempt to try to make sense of this, and it sort of has two components. First, we look at some data, and especially we have some bank level data from Sweden. It's pretty interesting. And second, we try to embed reserves into a standard DSG model and understand what the effect of negative interest on reserves are in that setting. I should say that, there's a sense in which we limit ourselves to really just focusing on the degree to which negative interest rate on reserves can have an effect through bank lending channel. There might be other channels that we are not taking into account. And I mean, that's just a limitation I want to be upfront right from the start. So as we have seen in these countries, negative central bank rates are clearly feasible. I guess the question is just what do they do? Are they expansionary, or are they just working normally? And of course, this is already an issue. There are several central banks currently experimenting with this. But when I give this for U.S. audience, I just like to remind them of that. Even if we are away from the zero bound now, it looks like it may be an issue pretty soon. If you just look at the three last recessions, and the gray bars here, NBR recession, we cut the rates by 7% in the first in response to the first recession. Then after the dot-com bust, we cut the rates by 5.5, and then in response to the last recession, we cut it by 5.25. And the point is that the blue line here is the short rates, and the red line is 10-year Treasury. And as you see, there's downward trend in 10-year Treasury, meaning the room is getting smaller and smaller. So even if now we are at we're close to 2 actually, it seems pretty likely that we won't have the same room as we had in the last 3, cycles in terms of cutting rates. So I think it's gonna, even if the Fed hasn't experimented with negative rates, I think it's going to be probably on the table for the next recession, or at least fairly likely to be. So it seems like something we should think pretty hard about, and this is, one attempt. This is our attempt to sort of, begin that conversation. I suppose when you look at sort of what people were saying prior to these policy experiment, I guess there was sort of two camps. On the one hand, you had a lot of people saying cutting the repo rates below zero, like this is from the Swedish Riksbank, at least if the cuts are not very large, is expected to have similar effects to repo rate cuts when the repo is positive, as all channels of the transmission mechanism can be expected to be active. The Swiss National Bank stated the laws of economics do not change significantly when interest turned negative, and before Carney came to the Bank of England, they seemed to be more positive about the possibility of going to negative rate. This is from a report from 2013, suggesting there was nothing special about going into negative territory. On the sort of more skeptical side, you have Mark Carney, that then came to the Bank of England, suggesting he was not a fan of the negative rate. We see negative consequences to the financial system in other jurisdictions, or Waller at the St. Louis Fed, suggesting that at the end of the day, it was just like taxing cheap clothing, charging interest on reserves, and few economists would ever claim raising tax on household with stimulus spending. So why would they think negative rates will? Then was this common perception in sort of the banking sector that you heard about, and I'm sure you heard a lot, was this concern that this would start affecting bank profitability in a negative way, and via that, constrain their ability to lend. Okay, and this is sort of that is going to be one mechanism we're going to see play out in our model. Okay, so what we're going to do, we are going to first use aggregate data, and we're going to document that, which I don't think was that obvious ex ante, but one thing that just seemed to turn out to be the case, that deposit rates, at least in the countries that have experimented with this, do seem to be bounded by zero. Okay, so even if you can charge negative interest on reserves, it appears that the banks are reluctant to charge their own depositors. And one of the implications of that is, and we're going to see that in the data, but also in the model, that the regular transmission, which works via, they say, the repo rate to deposit rates, which is the main funding source of funding for the banks, is that then the transmission becomes a lot weaker into lending rates. Okay. Now, in order, of course, to be able to model, we need a model with multiple interest rate, and I'm going to provide you with a very simple extension of the New Keynesian model that allow us to think about, interest rate on reserve, deposit rates, and lending rates all at the same time. Okay, so that's going to be sort of our objective. First, we can look at some data, and then I'm going to try to incorporate what we see there in the data into a model. So what we're going to find, just to give you the bottom line, is that the negative rate on reserves are actually not going to be expansionary. And the reason is going to be that they don't affect the financing cost of the commercial bank, because they are bounded by the zero bound themselves. So there's going to be limited impact on the interest rate faced by household, both in the model and I'm going to suggest in the data as well. And the negative impact on profit could even feed into, we're going to see in the model, I mean, under some assumption, can even feed negatively into or actually raise the spreads the banks need to charge, and thereby potentially have negative effect on aggregate demand. So the negative central bank rates, in fact, can become contractionary. Now with Marcus on the line, I feel guilty not clicking on the literature and talk about his paper, but I heard that he was giving it last month, so I'm going to be obnoxious and just skip it. But, our papers, of course, are highly connected. And I think a key difference here is that we were sort of thinking about this through within a standard sort of New Keynesian model. And we had data from Sweden. And I think Marcus was more emphasizing the fact that the banks are charging spread over the, they have some sort of monopolistic power, which we don't really have here. So the modeling is slightly different, but I think they broadly speak to the same question, the two papers.
Gauti, can I ask a question?
Yeah.
I wanted to know, so you're saying in the data, it's the case that the deficit rates are bounded at 0. And obviously, you're going to bring this somehow into the theory model. And the question is, do you simply impose this as an assumption, like the 0 lower bound on the policy rate previously was imposed? Or are you going to somehow microfound this?
Yeah, I mean, I am going to impose, I'm going to propose like a storage type technology. So that is going to, so the reason why this bound is there is that the depositor has the option of taking the money out of the bank, right? And then I guess there's going to be some cost of storing, and that's going to give us a natural bound. So we'll discuss that a little bit, because one reason, rather than just simply imposing it, but having a bit more explicit foundation, is that we wanted also to relate a little bit to this idea that many people have proposed that you should tax currency, which we can then talk about. But I don't want to oversell the micro foundations there. I mean, it's just basically the reason why this bound is in the model is that the households have the alternative of taking out the cash and storing. But there may be cost to that. So the bound on the deposit is not exactly 0. It's going to be determined by this storage fee. In the data, it looks like, though, it looks like it is 0. So meaning, so for the model to be consistent with that, there would have to be no basically cost of storing money. I mean, I think
another question here.
At the end of the day, I think it has probably a little bit more to do with people are reluctant to impose that cost of customer because it's unusual. It would make them, and we have some surety evidence I'm going to show you, but let's get there maybe when we for some reason I have a very difficult time moving my slides without jumping. Okay, so let me start here with some data, okay, and pass through.
So Gauti, maybe before you move to the data, Gauti, so before you move to the data, so I think before is from the Bank of Canada, you mentioned earlier that Mark Carney was looking at is not a fan of a negative rate. So here. As a big question, as a kind of a bigger picture question, is the financial stability implication of a negative rate. Is this something that you are considering, or what you can elaborate a little bit on that before going to the model? That would be helpful to us.
Well, what's going to happen in the model is that it is going to have negative effect on the profitability, on the profits of the bank.
So it's just on capital only, bank capital only, no.
Well, basically on their ability, their financing costs, and
so
I suspect something like that in mind. But I think you are in a better position than me to speak to what exactly he had in mind. But I just noticed that when he came there, that he seemed more negative about it. But I don't want to be too...
No, so I think it's more general than that. Basically, my issue is that I understand you want to put in a DSG model, which is helpful, but it seemed to me that with negative, like the one key concern is really the financial stability implication of that. So that's kind of the part that I have the same question on Marcus' paper last time too, but that's the same thing here for you too. I just want to get a sense on that.
Well, I mean, I guess I didn't interpret, so, people have concerns in general about the financial instability associated with low interest rate in general. So I don't know if there's anything special about the negative versus positive there, except I think perhaps this thing that we are trying to point out here that their financing costs appear to be, I mean, their main source of financing, namely the deposit, appear to be bounded. So
okay.
that's so, but we don't have anything more to say about it than that. I mean,
Okay.
you may have had in mind also just some general considerations about low interest rate in general, but I'm not
Okay.
sure. Yeah, I can't really speak. Okay, so let's take a look at some data. So this here shows the deposit rates in Sweden, and what's interesting about it is that you see here in you see the policy rate in dashed, you see the household rate in red, and corporations in blue, and you see that they moved pretty tightly together before the policy rate go negative, but then once policy rate go negative, it appeared to be bounded there at 0. So that's just past this dashed line, and once they turn negative, it appears that the deposit rates are bounded. Now, if I click here on the link more, you see similar patterns in Denmark, Switzerland, Germany, and the Euro area. A little bit less in the Euro area for reasons that a lot of the banks were actually, I mean, there may be some risk premium there. And we have some speculations about it. Our main focus is on Sweden because we have some more disaggregated data there. But the point is simply that, so in other words, they didn't even reach the lower bound in the Euro area because they seem to have been charging, maybe they had to pay some risk premium, the banks. In Germany, it seemed that they were coming closer. So, oops, I didn't go where I wanted. Okay, so now why are they bounded there at 0? Now I'm going to have a story in the model, which is basically that, well, because people have the option of taking out the money and storing it, the banks are reluctant to charge, or they're not going to be willing to pay. You know, that's perhaps, but if you just go and ask people, you know, the customers, so this is survey evidence, what would you do if interest rate on saving accounts fell 0, for example, to minus 0.5, so that you receive less money in the future than you originally saved? You know, over 70% say that they're gonna take the money out. Okay, so now it's conceivable that people's attitude would change once you start actually charging, and they realize that the alternative of storing it in their safes, buying safe, is not that attractive. But you can see right here why banks have been reluctant to breach the bound, because the customers are, you know, going to react negatively for, you know, maybe because they think they have alternative way of storing money without that high of a cost.
So Gauti, in your data shows
okay,
that,
now so
Gauti, just real quick. The data showed that deposit rates for firms were negative at times in some countries. Why do you think this doesn't hold for firms, or do you think it doesn't hold for firms, or why is pass-through supposedly?
So let's take a look at. So here we see, so in Denmark and Germany, that the deposit, I suppose when you have very large accounts, I think maybe the cost of storage becomes high and you're more willing to pay for transaction services. Now, we don't have it in the model, but, you know, that's certainly one dimension that, you know, might work in favor of the policy, that, you know, those large customers that really need liquidity services are willing to pay for it more than, say, the households. And I think yeah, that didn't seem to have happened in Sweden, but it seemed to, like you point out, we do seem to see it more in like in Denmark and Germany. So I think, you know, so I don't want to like overstate the bound, but I mean, there seems to be something going on there, and you know, that they are reluctant to go, and you know, even in those in these corporate rates, if you just take a brief look at it again, you know, they were not going much, just, you know, mildly below 0. And we also looked at fees, and it didn't seem like, you know, that would be one alternative, just the fees increase. We didn't see strong evidence for it, but that is not to say that perhaps at some point, you know, banks will be more aggressive imposing fees. I think, though, the bottom line, though, is that there's going to be a bound on this because of this alternative of being able to store cash, and, you know, and then at some point you might just, you know, take it, you know, it might be profitable to have just a pure storage facility for cash, you know, so you only pay the storage costs, you know, so that's, you know, in fact, in our model, the exact bound is not going to be 0. It's going to be like something called minus gamma, which is, you know, given by the storage cost. So I wouldn't be surprised if you could go a little bit below 0, even for if this is a permanent state of affair, even for household. But I think there is going to be a bound as long as people have this alternative to.
So Gauti, do you have data on these fees as well?
We have it. So Ella, we looked at some, right? So here I'm.
We have aggregate data, but no bank level data, which would be great, but we don't have that.
I just noticed from my German bank account,
okay.
I pay a fee now.
Yeah, so I hear all these anecdotes from people that so I'm reluctant to go down too hard on it, because I hear, like in Portugal, apparently some fees have gone up quite a bit. So, but in aggregate, we looked at and doesn't seem, but, you know, I think that's something to be studied further. Because, yeah, obviously that would be a way of implementing somewhat negative rates. But my point is that I think there's going to be a limit there too, right? Even if it's not exactly 0. Okay. Now, yeah, go ahead.
I mean, a fee typically is always a fixed fee. You know, it doesn't depend on the amount you have in the account. Perhaps that's.
I am not sure. Yeah, that I think requires further study. My understanding is like, yeah, no, I don't know the answer to that. That's something that this group of people seem to be in a position to explore further. We haven't been able to get our hands on data of that kind. Now, why do we care about this? Well, we think about this as working presumably through a bank lending channel. And here we see the lending rate in Sweden. And, you know, looking at the aggregate data, it's not like, doesn't totally steer you in the eye that there's no effect, which is, but what I'm going to show you, which I think is perhaps more compelling, is just looking at the individual lending rates of the banks, because that's, I think, relatively striking what you see there. So here, this is suggestive, I think, if not conclusive, that the transmission, you know, seem to be lower. But let's take a look at actually the bank lending rates that we got. So in here, what you see is in the dashed line is repo cuts by the Bank of Sweden, okay? And what you see is that there, at each case, when they cut their rates, you see that the lending rates, so these are mortgages, these are 5-year mortgages, was it? Yeah, 5-year mortgages. And you see they follow quite closely. The Bank of Sweden cuts, and these are what, 11 banks? And we see each of these banks here cut pretty much straight away. And we see very tight correlation between the bank rates and sort of the transmission into 5-year rates. But then you hit the 0, and what happens then? Well, this, right? So at the first cut, you know, things go down, and then they just seem to, A, there's a big dispersion. B, it's not even obvious if they're going down or not, right? So here they went from 0 to -1, and then we went to -25, then -35, and then -50. And we see some sort of a breakdown here, right? Or it looks that way. This sort of, you know, put a minute. Yeah, go ahead.
So Sweden is special because Swedish banks have a lot of wholesale funding, so it's even more striking in a sense. But
yeah, so we have in the page. Yeah, no, it's a good.
If you look across the banks,
so, you know,
banks which have more wholesale funding react differently from banks who have less wholesale funding.
Yeah, I'm going to show you some evidence evidence on that. It's actually interesting. So what Marcus is suggesting, which is, you may say, oh well, it's deposit is just part of their funding source. I mean, they also it's about 50%, and that's relatively lower than in other European countries. So it's all the more striking how the fact that this breakdown happens in such a severe way. And I'm going to show you in a second some suggestive evidence about the relationship between the degree to which they rely on deposit funding and the degree to which the pass-through is lower. So this here shows you breakdown in pass-through post-zero. And so these are sort of, I guess, box charts. I guess it's the 25th and 75th Reserve Bank, and shows you the max in, and the middle is sort of the median, and you can see that they are moving. Before zero, there is the correlation of the lending rate of the repo is sort of relatively close to 1. When it reaches zero, that's the gray, it becomes weaker, and then these interest rate cuts post zero, you're really seeing very little correlation, even negative, right? Well, the big thing you see is this huge in dispersion, but the correlation is actually negative. Okay. So this here just shows you this pass through to different maturities: 1 year, 3 year, and 5 year, and it seems to be sort of hold across 1, 3, and 5. Okay, floating 1 year, 3 year, 5 year. Okay, so the blue line shows you we include there the interest rate cut that went from down to what, -1, right? And the other shows you when we just focus on those that we're going deeper and deeper into negative territory. Okay, to Marcus's question. So one interesting question is, the first observation is that it is curious how this breakdown is rather striking in Sweden, given that their average funding from deposits just about 50%. So one thing you can take a look at is the degree to which the deposit share is driving this correlation with the repo. And here, I guess we see some evidence for that. Bank with high deposit share have, low pass-through, right? So that's sort of, and here, this is a regression line where I guess each bank gets more weight based upon its size. Originally, when we run this regression, there was this tiny bank up in the right-hand corner that was sort of messing things up. But once we weighted them with their share, it seemed like, the higher the deposit share, then the lower the pass-through. Okay, and then with the upper left corner, you saw, some of these banks that did not rely as much on deposit, like 0.3 here, then it seems to have had some positive effect. But I think this is a reason to be somewhat pessimistic for outside of Sweden, because there they tend to rely even more on deposit as a way of funding. Okay, this is sort of consistent also with work that Heider et al. Have been doing with in the European area bank, showing that high deposit share have lower growth in lending volumes. That again speaks to Marcus's question, and this is basically just taking their regression and showing that deposit share seem to be associated with lower growth rate in lending after the policy rate went negative. Okay, and it appears statistically significant. Statistically significant. Okay. So so what have we learned here? I guess what we have learned is that it appears that deposit rates are bounded at close to zero, maybe slightly below for corporate rates in some countries, and maybe they could even, if this lasts longer. I don't think it's impossible to believe that the degree of fees might increase more than we have seen so far, but I think there is some bound there. So that's number one. Number two, there is this somewhat striking, collapse and pass-through from the lending, from the policy rate to the lending rate that happens right around zero, and that is something worth exploring, and is suggestive of that, you know, at least to the extent you think that negative rates work through lending, the bank lending channel, that something is breaking down. So the next thing that we want to then think about is, can we put some structure on that, why that is happening? And to do that, you know, we just do a relatively standard Newtonian model, but extend it to include the banking sector and reserves. Okay, so let's take a look at what the model looks like. So here we have two types of households. We have basically a borrower, well, with an impatient guy and a patient guy. So the impatient guy just has a lower discount factor than the patient guy. So in equilibrium, there's going to be borrowing and lending in this economy. The impatient people are going to borrow from the patient ones. Okay, and there's going to be a fraction of household that are patient, 1 minus chi, while the impatient ones are going to borrow, and they're going to be of measure chi. If you look at the utility function, it's just standard. I mean, CT is just a consumption Dixie-Stiglitz index. We're going to allow for a preference shock here, XIT, and we allow for that because we're going to, our thought experiment is going to be that the zero bound is going to be binding, or I mean, we're going to have a shock that makes the zero bound, makes the interest rate fall, and then explore the consequence of imposing negative interest on reserves. So the BTJ is just the debt holding of each household. M is the money holding. And then we were coming to, okay, do we impose the zero bound? Well, what we do here is we have this function SM, which is just denotes storage costs of money, right? So, and then finally their profits from the firms. So in other words, the household always has the option, rather than depositing its money at the bank and receive returns, to instead just store the money. So the money demand here is then going to be given by, so these function omega and U are just sort of going to equate the marginal utility of holding money over marginal utility of consumption to the interest rates, right? And, you know, the only difference relative to the typical money demand function is now you have this storage cost there. So what that allows you to do then is to contemplate the possibility that there's not a zero bound, but there's some other bound that is negative and is just bounded by the storage cost. That bound would be, you know, gamma here, or minus gamma, in case of a proportional storage cost of money. Okay. Okay, so that's sort of, so the consumption side is relatively standard, similar to what I've done in some earlier work with Inyo and Romay. On the firm side, you know, production is linear in labor, and we steal a trick here from, or borrow a trick from my paper with Peter Paolo and Romay, where we have each the labor is a Cobb-Douglas of each of the labor of each type of agent. And the reason is that it's just convenient, because then under this assumption, the income of each type is just going to be proportional to aggregate output. Okay. Now each firm is going to face a downward sloping demand function, you know, given Dixit-Stiglitz preferences in the background, and we're going to have Calvo prices. Okay, so what are the banks doing? So the banks are earning an interest rate on their lending. I mean, they're right. They holdings. They pay a storage cost to holding money, and then they pay an interest on their deposits. And we are imagining that that the households basically, what they can do, they could either hold money or they could deposit, you know, their money in a bank. Okay. So the liabilities are deposits, and there's one thing here, I guess, that is somewhat important, which is that the way we are modeling here reserves is that it's an asset. But in some case, I think, you know, when the ECB started implementing negative interest rate, it was also associated with actually extending credit at those negative interest rates. And you would expect that to transmit into borrowing rate. But in the case, say, of Sweden, it's not like the bank is extending credit at it's just what the banks themselves are paying for the reserve holding at the central bank. Okay, so we have an intermediation cost here, and that's just going to be some function here, gamma, and it's going to be higher the more lending is being done in X. We're going to imagine that the reserves reduce the cost of intermediation of the bank intermediation, but that there is a satiation level. At some point, you hold enough reserves to execute all your transactions, and you know, then you're told it's not reducing your intermediation cost in any way. Similarly, higher money holdings reduces these intermediation costs, and these are all just sort of reduced form way of characterizing why banks hold both reserves and money, and then also a reduced form of characterizing what is the cost of lending. It's been found in other papers, the cost of lending via default, for example. And I'm just gonna impose it here in this function. Now there is a fourth assumption here, which is that, and that is also just reduced form, but one that I think one could go into better details of, is that the higher profits reduces the marginal cost of lending. Okay, and we can turn this effect on or off. So what do we have in mind here? Why would you think that profitability of banks should affect their intermediation cost? So, you know, if to the extent that you believe that the banks are capital constrained to some degree, then you would think that there's some link between their net worth and their financing cost and credit supply. You know, and that is one of the main concerns people were raising when they were talking about interest reserve. There was the concern that it would affect the bank's profitability, because remember, on the asset side here, you have the reserves, and the central and the banking sector as a whole is holding reserves at the Bank of Sweden, and now suddenly they're paying interest on that. I mean, now the banks are being charged for that. Okay. So the bank maximization is just subject to a balance sheet constraint. You get these first order conditions with respect to lending, reserve holding, and money. I don't know how much it's going to tell you to stare at these first order conditions without me going into excruciating detail here. So let me instead just sort of march on and just talk about how we think about policy in this setting. Okay. So this is the bank choosing the amount of lending, they're choosing the amount of reserve, and choosing the amount of money they're holding. Okay? So the central bank is going to control both the supply of central bank currency and the interest rate on reserves. The banking sector then decides whether to hold central bank currency as reserves or money. Okay? So the central bank supplies enough central bank currency to banks basically satiated in reserves whenever they can. That's the assumption we make, and that would be optimal here. And in this case, when the banks are satiated in reserve, we saw from the first order condition here, the second one, well, that's going to imply that interest rate on reserve are just going to be the same as the interest rate on deposits, okay? Or that's the risk-free rate. So we're imagining the central bank controls the risk-free rate simply by setting interest on reserves. So I suppose this is one difference between what Marcus was showing you last month, in that he had, if I recall correctly, some sort of a spread there that banks had some market power. Okay, so the central bank is going to set the IR according to a standard Taylor rule. Okay, and then the key observation is going to be that while you can charge negative interest rate on IR, the IS, which is the rate faced by the depositor and the banks use to finance themselves, that rate is going to be bounded by minus gamma. Okay? So under normal circumstances, the central bank is moving about IR and IS is fall on, but then once you go below that minus gamma, or let's just call it 0, that link is broken.
So, okay. Can I ask you 2 questions? So if you are above 0, is the perfect pass-through in your framework, or is it just when you go below, then the pass-through breaks? Is this correct? Or?
Yeah, so there's perfect pass-through from the interest on reserve to the deposit rate.
Yes.
But there is a spread then between the and it's going to come on the next slide. There's a spread between the borrowing rate and the deposit rate.
Okay. And bankers,
because that comes, and that's because of this intermediation function that may include default, but also cost of holding, let's say, reserves or money, or profits. The net worth may enter there too.
And the bankers
maximize
so the 3 problem, no? They maximize this period.
What's that?
It's a 1-period problem so far.
Yes, exactly. So and I haven't gone much to the details here, but we do follow Kurdi and Woodford in simplifying the bank contract in such a way that a bank is just a 1-period contract. It's a bank takes a deposit, it extends loans, it can perfectly forecast the degree of default there's going to be, or any intermediation cost at time t, and so it just stores enough money to pay off their deposit in the next period and pays the rest out in profits. Okay, so the 1-period bank contract then relates together interest on reserves, the deposit rate, and then the borrowing rate. And above 0, the interest rate on reserves and the deposit rate are going to be moving 1 and 1, and then there's going to be a spread to the borrowing rate due to these intermediation costs. Okay.
Yeah.
So
one more question.
Yeah, go ahead.
So you're assuming that the cost of storing cash is the same for households and for banks, right? This function.
Yes, I mean yeah. So I mean, to be honest, we didn't really go into when we did our simulations, and this is perhaps Eric going to further. We didn't really go into the details of thinking about the bank's ability to store cash, and try to model that in more detail.
But in principle, would you agree that if the banks faced lower costs of storing cash, then the pass-through would even be more impaired, a negative? That should be right?
Yeah. So right. Well, I guess that would allow them to. I would need to. I don't want to. That sounds right, but I haven't worked it out.
Okay.
So I hesitate to. I mean, there's an interesting question too in because like Marcus was saying, this is a 1-period bank contract. Once you start thinking about it more realistically, in the case of Europe, if these negative rates become persistent, then banks start really thinking about the viability of building storage facilities for cash rather than pay and that's a fixed cost. And I guess one reason we didn't go into detail there is that so then it's going to depend a lot on what people expect, how long people expect this to last. but it would seem like that would put the bound even tighter in some respect. That people would just stop using reserves, you know, stop storing money in the central bank as reserves, and instead just as the currency, sticking it in a storage facility, and you know, the cash, the way in which bank would settle their cash balance would just be outside of banks, because it would, the central bank, if they charge too much, they would find or a cheaper way of doing it themselves in some fashion. And I think that's a limit, you know, we haven't really modeled that here, but I think that's relevant if you start charging a very high negative rates on reserve. You know, the banks just start settling their balances via some private outfit that is less costly. Okay, so what I show you here next, and you know, I know I guess it is an hour, so that's my excuse. So I don't go into great detail here. I show you here just, so it is a DSD model that has this one period banking contract. It has a borrower, and it has a saver and a borrower with a spread, and it has interest on reserves. So this here shows you a linear approximation of that model, and it basically is takes the standard New Keynesian form, where, you know, the first one is just the New Keynesian Phillips curve, then the New Keynesian IS equation. And the difference relative to the standard one is that the natural rate of interest now, the real interest, you know, you would need to set for full employment, is now a function not just of the preference shocks, which are these squiggles, or what do you call them, but instead also of the spread. Omega t is the spread. It's the spread between the borrowing and the saving rate. And that's an endogenous object now that is determined by a set of equations that I'm not showing you here. But in particular, it depends upon the level of outstanding debt. So that's, you know, if you look at the expression for omega t hat, the level of outstanding debt is going to be one important component there. The higher is the debt, the more likely is default, and the higher is the spread. This B bar is debt capacity, and that's like one of the shocks that the literature often considers as a trigger for a CLB episode, that debt capacity for whatever reason goes down. And then finally, there's this set T, which is the profits, one period profits of the bank contract. Because remember, we assumed that the intermediation cost was a function of the profit of the bank contract. Okay, so you can see there how interest on reserve might potentially be contractionary. Why? Because it's going to have a negative effect on profits. Those profits are going to then raise spread. Okay, so there's going to be a standard Taylor rule for the reserve rate, which is the second to last equation, but the lower bound on the deposit rate given by the storage technology. Okay, so that's the model, and I guess what it is, it can be expressed in this relatively simple form, but it's somewhat deceiving, the simplicity here, because there is a set of dynamic equations that determine the evolution of the choice of debt the debtors make and profit and equilibrium. And I just don't want to clutter things up here with those set of equations. But I just want to point out how similar it is to the standard New Keynesian model, except for now that this natural rate of interest is endogenous, the spread, and the spread in turn depends on the profits, which gives you then possibly a link between the interest rate on reserves and having negative effect on profits. Okay, so the intuition here, so the shock hits, the zero bound, the central bank lowers IR, with no bound, there's an identical reduction in the deposit, 1-to-1. Savers increase their consumption, and there's going to be increase in demand. Okay, because, you know, this implies lower financing costs for the banks, so will the borrowing rate is going to fall as well, and borrowers increase their consumption. On the other hand, when IS is bounded, this this transmission mechanism just breaks down, because there the reduction in the charging interest on reserves is not trend to the funding it's not reducing the funding cost of the bank. And because we're assuming rather extremely that their only source of funding is deposits that are bounded, right, which is, you know, an exaggeration, of course. This then shows up in a negative effect on profit, and thereby, in fact, can have, in fact, contractionary effect, like we'll see now. So let me just give you a numerical example. So I have 6 minutes. Okay, these are numbers. Take to from the literature. I think there's nothing really funny going on here, except for we have to pick this linked profits and costs, which is somewhat, which is sort of, yeah, special here, and we just explore different values of it. I'm not sure I would want to. I'm not sure that we have that strong evidence of what the actual value there is. So what we're then going to do, we're going to parameterize the model as described here by this table, and let me not go through each and every single way parameter. Just hope you believe me that they're relatively standard. Whether that makes it more comfortable or not, I don't know. And then I'm going to pick the shock, the preference shock, and it's persistent, to generate a 4.5% drop in output on impact. Why 4.5? Well, it sort of looked like a reasonable number given what we saw in Sweden. But, you know, I would be perfectly happy to pick it to generate a bigger impact. We just want to try to see what policy is still in. Okay? So there's going to be this shock that is essentially going to reduce the natural rate of interest absent, you know, anything else, or we can alternatively, we do in the paper also, a decrease in debt capacity. I guess this is sort of what Krugman and I called a Minsky moment, sudden reduction in debt capacity. People had overextended themselves. And, you know, they have sort of similar effects. I think in the picture here, I only show you the experiment with the first one, which is just a preference shock. Okay, can the central bank counteract this drop in output that might result from the drop in the natural rate of interest due to, let's say, a preference shock or debt deleveraging shock? Yeah, in the standard model, it just reduces rate to offset it. In the standard model, of course, both IR and IS are bounded. So that would be one case. Case number 2, we're going to see this in the figure coming up. There's no, both of them just accommodate the shock. And then we're going to impose just the bound on IS, the deposit, but not on IR, and see what the marginal effect is on charging negative interest on reserves. And what are we going to see there? We're going to see that, you know, in fact, charging negative interest on reserves is going to be contractionary through this profitability margin. Okay. Let's see if we have the figure here. And the figure here shows you first the case where you just where the dashed line is where you can, there's no bound on either rate, so you fully stabilize output and inflation. Okay. The standard model where there's bound on both the deposit and the reserve rate is the solid line, and there you have some contraction in considerable contraction in output and drop in inflation from 2 to 1. Okay, and then finally we think about, well, what if we charge negative rates according to this policy rule, and there you get like you know, a worse drop in output and a bigger drop in inflation. And what you can see there even is that the borrowing rate actually increase, right? Because of the lower profitability of the banks, they actually charge, the spread actually increase between the deposit and so this is just then working as a tax on the, yeah, go ahead.
Can you explain how you get to this minus 16% policy rate?
Yeah, so this is just literally from the policy. So I don't want to, this is just the policy rule here, right? Mm-hmm. This is the Taylor rule, and because we have a big output gap, that just implies we have a considerable. So I don't want to, nobody went down, of course, to 15% rates on rate, but this, following that policy rule. Instead, what people did, they just, small deviation of the interest rate or of reserve from zero. Okay, so this is just illustrative, let's say. Okay, so and the mechanism here is that there's a negative impact on bank profits from or going negative. Okay, then it just becomes more so at and this here just shows that the degree to which this negative impact shows up is going to be a function of how strong the profits. Okay, and that's what this table is showing. So I'm out of time. So in the model, negative rates are never expansionary on reserves, but it relies on stark assumption, in particular about the funding of the banks, to the extent that these negative rates, and with some evidence of that, will translate into lower corporate rates. So when banks were seeing that they were being charged on the reserves, they tried to find alternative assets that had dominating return, including treasuries and government bonds. And there's some evidence that some of them went down to the extent the bank could finance themselves with such bonds that might be useful. On the other hand, if you look at Sweden, actually, there was no increase in non-deposit financing post-zero, which is interesting. You could have thought that fact might be important, but at least so far, it doesn't look like it. Now, the bank fees could effectively lower the debt, but they eventually would be subject to some bound. And, at least what we have, Marcus has already told us that his bank fees are increasing in Germany. So we have some anecdotal evidence that that's happening somewhere. I met a colleague of mine from Portugal was telling the same story for Portugal, that we haven't been able to find concrete evidence from increasing fee, but in any case, it's going to be lending. Now, there are alternative transmission mechanisms. So we are focusing on the bank lending channel. There are alternative transmission mechanisms that may or may not work. I don't know. The Swiss bank emphasized a lot that it had some effect on the exchange rate. And then, like I said, it may have an effect on some, alternative assets like corporate bonds, and possibly thereby affecting the financing cost of the banks. Okay, so conclusion, negative central banks do not seem to have passed deposit rate, and that seems to have implied too that the pass-through to lending rate is more limited than you see in the regular circumstances, and I think the evidence was pretty striking, at least to me, in Sweden. And we saw that they seem to be tied to some extent to the degree to which the banks finance themselves with deposits, suggesting that the zero bound really seemed to have a lot to do with agents that think of them being able to holding money as an alternative to, as an asset with zero return as opposed to a deposit account. Potential negative effect through lower bank profits and credit supply, but potentially positive effects through some channels that we have modeled, exchange would be one of them. But the bottom line, I suppose, is that negative rates here is not business as usual. It is fundamentally different, at least. It looks like it according to the data, and it looks like it if you put it in a relatively standard model. So I think I'm out of time.
Can I ask a quick question? So if you have banks which are better capitalized, how would this would show up in this cost function? If you compare across countries and say, oh, in this country, the bank's extremely well capitalized, and it would be less of a...
Right. That's an interesting, so you would expect those countries that were better capitalized. So remember, if the profits don't have any effect, then if the profits don't enter the intermediation function, then there's going to be no effect, right? It's not going to be contractionary, not going to be expansionary. If they enter, you're going to see an increase in spreads as a result of the as a result of the interest on reserve. So that has cross-country prediction, which is for those countries that charge negative interest on reserves, in those countries that have undercapitalized banks, you should see an increase in spread, bigger increase in spreads there than in those, and you should see no increase in the spread of those countries that have very well capitalized banks. Is that true in the data? I don't know. I mean, that's a testable prediction. That's an interesting.
Can you, in your model, can you talk to the creeping up effect too? That
creeping up?
like,
of what?
If you have a low interest rate for a long time, actually the reversal rate is creeping up over time. So it can go negative, but not too far. But how far it can go negative creeps up over time. Is your model, can you capture that?
So we don't have, no, we don't have that. I mean, my intuition is that, you know, as interest rates stay negative for longer, and we have some discussion of this, then it might become profitable to come up with some alternatives to the central bank's, you know, the central bank services to banks in terms of settle accounts. It becomes, you know, expensive. If you're charging a lot for those services, that's what people hold in reserves. It might make sense for the commercial banks to take out the cash and put it in a private facility that charges less. And then, so there's dynamics there. That would imply huge fixed cost, right? So to the extent you would have this lower for longer, you might expect, we don't have it in the model. I can imagine that being a relevant factor. I guess if we would have dynamics in the net worth, we might have some dynamics, but we don't, because we had just this one period bank contract.
So I mean, coming back to the empirical evidence, right? So do you know anything about deposit rates in the case of Japan, where we saw the zero lower bound for a much longer period?
So did we have, I think we had, yeah. We have it here on the slides. I think we have it in the paper. So there, I mean, we see the same thing. Let's see.
The case with Japan is that they only had one implicit cut going from a positive to negative rate, with less variation and sort of less useful information than in the Swedish case. But I think the response in Japan was not very strong.
I mean, the deposit rate was still, it seems to be bounded, right? If I remember right. At some point we had it, but now I'm going to put it back in, I guess. So but they only had, yeah, they didn't have, oh, here it is. Yeah, so I don't know if you see it. This is not going to do a whole lot. Let me just tell you what's there. You have to take my word. So it goes negative, but the deposit rate is bounded by zero in Japan. Okay, it happened in 2000.
Thanks a lot. So then there is another question. Could you say a few more words about the definition of the natural interest rate in your theory model? I mean, you said it's going to be conditional, or basically it's going to deliver full employment, but what is the assumption about the financial frictions in that context?
Yeah, it's a good question, and one that you know is sort of the focus on my paper with Peter Powell and Romay, where we tried. I mean, the point there was basically to show the parallel between this model that has dynamics due to, you know, debt holdings in the banking sector and the new Keynesian model. And we just showed that it could be boiled down to the same two equations, with the exception that now the interpretation of this RTN, which is the real interest rate you would need to achieve, you know, zero output gap and zero inflation, or inflation at target and output at target. That's the interpretation of that object. but that object is now endogenous because the level of indebtedness of the households. In particular, when you have like a debt deleveraging show, you know, that's going to lead to this object being negative, and then the natural rate of interest is going to then go slowly back to normal, but that's going to be determined by the dynamic deleveraging decisions of the households. So yeah, the interpretation here is similar as in the standard model, but it's now an endogenous object that depends upon the spending and borrowing decisions of the agents.
Let's thank Gauti for his presentation. Thanks a lot.